got to assess the market's volatility on a day, particularly at the moment where the volatility can be high. It can be high for no particular reason than the US market or another market that's affecting, say, the Australian Stock Exchange, for example, is the reason for it. So in reflecting upon your performance, assess the market volatility for the day. It may help you answer the question of why you won or lost on that day as well. Okay, if volatility is falling and a market starts to consolidate around a range, in other words goes sideways, you know, where are there new support and resistance levels? If so, then you know, you need to assess this. Or does the volatility, because the market has been going sideways and volatility has been low, is there a possibility that volatility looks like it's increasing with a potential for a breakout? A breakout could be either up or down. If it's down and you're long, do you need to take account of that? Do you need to exit your position? If it's a breakout on the top side, then maybe you may look to add to your position or take a position in a similar asset in the same asset class. It will be part of your trading plan, and you need to review this in your reflection. Make a note about what's happening in the market tomorrow. If you've got open positions, it's going to impact you. If something happens, it is going to impact you. It will be may be positive, it may be negative, but it's important to know what is going to happen that may lead to abnormal trading conditions. Typically, this will be, say, an FOMC or a Reserve Bank announcement after a board meeting on interest rates, for example. If that's going to impact you because you're holding bank stocks or you've got a currency position in the Aussie dollar or in the US dollar, then you need to know that's going to happen tomorrow and take the necessary steps to protect yourself against that. The other things that you need to consider is, what do you do over holidays, for example? Holidays tend to lead to low liquidity. With rollovers in currencies, it can be expensive on the cash and carry. I can delve into that a little bit further if you want to when we do our next series of currency webinars. For example, do you trade Japanese yen over the Japanese Golden Week, which tends to be a full week holiday? Probably not. Do you trade over Easter when there's low liquidity and most of the world's on holidays? Maybe. Do you trade over Christmas and the New Year period when no one's really interested and there's extremely low liquidity and can be extremely high liquidity? Possibly not. You need to have these things worked out before you start to take positions. Basically, if you fail to plan, you're planning to fail. That's the whole reason we've written this trading plan webinar for you, because we want you to plan what you're going to do in certain circumstances. It's no more relevant, or it's much more relevant now than it ever has been because of the lack of liquidity. Okay, you've got to write it down. If it's not working, you need to be able to have the flexibility to adjust it. So basically, the things that you need to do is choose your trading medium. Okay, you're going to trade either with us or with somebody else. If you're trading with somebody else, then you can log off now. You need to have your psychological preparation to be aware of what's going to appear or what could possibly appear that's going to affect you. Be rational, not emotional. You need to predetermine your risk levels. You need to know on every trade you take how much position or how much risk capital you're willing to put on the table, and be prepared if someone takes it off the table because you make a loss. You need to predetermine your goals. These could be short or long term. You need to know whether your short-term profits are achievable. They have to be sensible. They can't be unrealistic, or they can be, but it's basically irrelevant if they are. And you need to have your long-term goals predetermined as well, whether it be weekly, monthly, yearly, or a combination. Do your homework and understand what you're doing, or what can possibly come out, where you're going to enter trades, where you're going to do certain things if certain events happen. And as part of that, you need to be able to prepare an environment around yourself where you're sitting or where you reside when you're making your trading decisions that is comfortable to you to give you the most opportunity. Prepare, know your entry and exit conditions. fairly important, this one. Obviously you need to know what you're going to do, why you're going to do it, and if you need to tick the boxes, tick the boxes. If you can't tick every box, possibly you don't take that entry position. And when you take an entry position, you should already have your exit positions, both from a profit point of view and from a risk or stop loss point of view, predetermined before you take that trade. The smarter trader will always have an if done strategy in place as he's placing the order, and most of you that I can see on here know how to do that on the if done order entry system on the GetTrader. You need to keep a trade journal as part of the reflection of your performance. Okay, the trade journal will allow you to reassess and assess continually what you're doing, how you've gone about it in the past, what was successful and what was unsuccessful, and more than likely why it was successful or why it wasn't. And you need to do this as part of a trading plan. If you don't, then that's fine, but it will hopefully assist you in adjusting your trading plan to reflect what's happening, because you will have to adjust simply on the basis that the markets are continually evolving and changing, that's regardless of whichever asset class you're looking to trade in. And as part of that, you need to be able to reflect on your performance on an ongoing basis, whether that be on a daily basis or on a monthly, weekly basis, depending upon what your trading strategy is. There's nothing more that